Canadians will find out later this morning whether there will be another interest rate hike.
The Bank of Canada is set to announce its interest rate decision at 10 o'clock in Ottawa. Experts are forecasting the rate will hold steady at 5% following the latest increase back in July. Canada's inflation rates, of course, we learned last Friday, ticked up to 3.3% in July year over year. But economists say cracks emerging in our economy will likely sway the central bank against further rate hikes. We spoke to Professor Ian Lee, associate professor at the Sprott School of Management earlier. He believes the key interest rate will stay flat because right now it's doing its job of slowing the economy.
When we have a significant decline in growth, a decline in GDP, rising unemployment, and because of the business cycle, this is a normal response, if I can put it that way. In other words, credit card delinquencies increase, consumer loans, unsecured credit, car loans increases. So this is something we've experienced in the past. I do not believe that it's going to have an impact on mortgage delinquency. I've spoken about this many times because I'm a former mortgage manager. The mortgage delinquency ratio in Canada for all of the country, as I speak, is 0.2. That means 99.8% of Canadians are current.
Meantime, real estate experts predict a fair amount of volatility in the GTA housing markets over the next few months. The Toronto Regional Real Estate Board's latest report shows home sales and prices barely wavered from July to August. The average home price dropped 3% from July to August to just over $1 million and was up 0.3% year over year. Treb says rising interest rates have pushed many prospective home buyers to pause their purchasing plans and sellers to hold off on listing properties.